Welcome, folks. We're going to give everyone about 1 minute to drop into the briefing, and then we'll get started. This should be a good show today because we're going to look at numbers, and everybody always wants to know, how do my numbers compare? Tim, is my revenue graph similar to everybody else's? Like, that's literally what everybody freaking wants to know.
Yeah, we should wait for that one to be last. Let's see.
Right.
Well, while we're waiting, we could say like we're happy to grab reports and put them against our charts and make that for people. We've done that in the past. I don't think we prepped for it right now, but we could pull that trick out of the hat again if that was something people wanted.
So yeah, let me actually amplify on that real quick for anyone who's wondering, wait, what did Tim mean by that? So over time, behind the scenes at RevThink, we have access to a lot of our clients' data. So we take it, we anonymize it, aggregate it, and share it in these metrics. But there are a lot of studios and production companies that we think would benefit by saying, hey, I want to contribute my data. Again, it's protected by NDA and so forth, to add to that aggregate information that we're collecting. And then we can share the full report with you, which gives you obviously a big benefit because you can start seeing like, hey, how does what was it, Tim? Like, how's our revenue tracking compared with everyone else in the industry? Those kinds of things.
Yeah, these key, we'll call them balance sheet matrix is what we call them internally. But the key factors that you have that you run your business with, and then looking at them as a trend in comparison to the rest of the industry, we find like what we're looking for is behavior, industry behavior, moments in time, and what you're saying too is like some kind of certification that you're on track or off track if you're not keeping up with others. Those kind of big picture ideas.
Well, I just read Ricardo's note that said, "Sup, everybody? Joel, Tim, hope you're doing well." So I'm going to use that as my excuse to shift into let's get the party started. All right, so Tim, I'm spotlighted. You're spotlighted.
We're spit-lighted.
Spotlit. Okay, then I can officially say welcome to this week's weekly briefing, which is sort of a special edition because once each quarter we do this industry metrics, which means we're going to look at data, we're going to look at numbers, we're going to ask the question, how did Q3 actually pan out for you and everyone else in the industry? And of course, that leads us into things like how's fourth quarter going to go? So with that, let me just first say, welcome to my co-conspirator and partner at RevThink, Tim Thompson, and you are tuned in to the weekly briefing, which is a free-for-all. That just means it's open to everyone. Conversation that we do every week for 30 minutes. We stop and we tackle a hot button issue, in a topic that's happening inside of our community of owners and leaders, or just something that we're spotting as, hey, we need to share this with everyone because this is important information if I was running a studio or a production company. So with that, Tim, I think that's the category or the lead in for what we're going to talk about today.
Yeah, I appreciate this quarterly report too. It's there's something about the opportunity to look at the big picture and kind of know how you're personally feeling in comparison to what's going on as a trend. We know that not everyone's having the same experience because we talk to a lot of people on a one-on-one basis continuously, right? Week after week. But there are big picture trends. And even if it doesn't exactly compare, there are things that we can show you that are in behaviors that you should absolutely avoid. Even if you're avoiding it currently, we'll give you some encouragement. Keep avoiding these trends because there are things that we don't want you to get caught in too fast. Waves get caught in too fast and then pulled out to sea. So we're going to keep you on the up and up.
Here's something I've observed, Tim, because I'm curious for your thoughts on this. When you talk about behaviors, something I noticed that my dad taught me, because he was like an investor and stock day trader most of his life. And he would show me this chart where the numbers, the data is going up. And he would say, Joel, what should we do? And I would say, we should buy, right? And he'd show me a chart where the numbers going down. He would say, what would you do? And I would say, I would sell that stock. And then he would say, look what actually happened. And the chart totally changed direction.
Yeah.
And I noticed how interesting it was, the psychology of looking at a chart that stops. It's amazing how our brains make these weird assumptions. And I'm doing this on a weekly basis, right? With owners that I'm working with, one-on-one. And we're really doing our best to say, based on what can we look at the past and draw any conclusions about the future? It's a very, I don't know, interesting experiment to perform on yourself.
Yeah, it's almost unfair how much our brain biases towards certain behaviors because it works against us. It helps us survive, but it works against us in making and predicting the future and decisions that we need to make. I also find that what I help people with the most is making the decisions in a timely manner. Sometimes the decisions are made too quickly, and I try to get them to slow down. And more often, they should be making a decision now, but they hope for something around the corner, and that just delay burns opportunity, cash, even moments of growth because they didn't hire a person in a timely way. So looking at our money on a timeline that we're going to see in the next 20 minutes or so is very helpful in the comparison of when we should be making decisions and why we make them and put them together to get some strategy.
Okay, so as a preface, I'll just say to anyone here that perhaps has been under a rock for this year,
Yeah, right.
that we saw Q1 as one of the worst quarters in recorded history for our industry. Let's say in the past, going back 10 years. And Q2, I'm going to say, was kind of worse than Q1 for a lot of companies, right? There were a few of you out there that, like, behind the scenes said, shh, don't tell anyone, but we had zero revenue for an entire month or for 2 entire months. It was brutal. So now, as we got into Q3, everyone was asking, is it over yet? Right? Like, is the bottom behind us? Are things, is this much anticipated logjam of demand and all this, like, finally opening up? So, Tim, I want to see if we can try and answer some of those questions today and give people a sense of, like, here's kind of what happened. So with that, am I sharing my screen?
I already know the answers. If I know the answers, I feel like you're
I know, like, Tim's not a prophet. He's not a, you don't have a crystal ball.
I looked already. Yeah.
Yeah. All right. So am I sharing my screen and
Yeah.
you, okay. So let me get my screen up here. I'm going to go to the top, and this is where we're going to begin. So what are we first of all seeing here?
Yeah, we should talk about where we get the information from. What we do is we've taken, as you said, studios data from across, this is a 3-year span. We're looking at, like, major trends on their balance sheet. So the items we're going to look at are balance sheet related items, and looking at where those assets and liabilities fall and possibly what's happening. So the first one, the easiest one to look at, is bank account balance. Not a whole lot of surprise here. And we can see very easily that the bank account balance are trending down. So the total amount of cash on hand for a company has been trending down. What is interesting is how long it's been happening. I know that we had a meeting similar to this meeting in late 2022, where I was telling people, watch out, your AR just took a hit, your accounts receivable took a hit, and you can't feel it yet because you have cash on hand and you're collecting that accounts receivable. But if you're not seeing accounts receivable in the future, it's going to go down. It's your long-term savings. So that moment where we were sharing that has simply played itself out since late 2022 through most of this year. What's great is, as how you'll see this compared to other charts, that it's a slow decline, which is good for most of us. You can imagine if your cash balance just took a major nosedive for a little bit, and then you're just hurting for a while. This has been a slow decline. So in a way, we could retain or buy ourselves the time we need to get to this moment right now, November, where there seems to be a slight now gain in the industry. So this is surviving. This is what surviving a bad year looks like, this slow drop. But if you look at like early 2022, how high it was compared to where we are now, that's what we're really feeling. How many people, Joel, do you talk to that say, man, like they wish this year was as good as last year? That's what they're really feeling, is those early 2021 to early 2022 months were just so good. It corrected itself and then beyond some. So we're kind of looking at that second line, and below that second line is where we're hurting. That second line would probably be like, the balance of what we're looking for.
Well, there's a narrative out there that I think is interesting, and I'm curious, what do you think of this, Tim? Is when I look at, say, this range, right? Call it end of 22, early 23. I would have thought that the cash would have been increasing because, everyone says 2022 was such a great year. It was almost as great as 21, or maybe it was even better. But it's like, yeah, but people were bringing in more revenue, but they were spending perhaps just as quickly. So the total cash on hand was actually going down from, last fall, from a year ago.
Yeah, that what you're looking at is because of that drop in accounts receivable. And initially it wasn't in a drop in accounts receivable. Remember, Joel, it skipped. It was like the pattern of AR was changing. So we got ourselves in a position where like the money was coming in just enough time to cover our last expenses, but we weren't gaining at all. So there's kind of this like flat line. And if you were familiar with July 2022, and then you're in December of 2022, and that bottom line is the same, you just feel like you're in a seasonal lull. Just feel like a 6-month regular move. What we were seeing was something more drastic. So
does
I didn't
anyone
expect
remember
the first quarter to be as bad as it was in 2023, but
here's a question. Does anyone remember last fall when Meta announced their big layoff? I want to say that was like October, or maybe it was November. That was one of those early indicators when we said, whoa, something big just happened. Summers, do you remember when that was? I bet you're you keep your finger on the pulse. You probably know.
Yeah, I think it was November, because it was following the Twitter layoffs, because the Twitter shutting everything down after the purchase was the bellwether for everybody to start cutting.
Yeah,
exactly. Like end of October, beginning of November, I think.
Yep. Okay, thank you. Okay, so Tim, I know we're going to run short on time, so we should probably keep trucking here. You want me to go down?
Keep going.
Okay, here we go.
So this is exactly what we felt, right? Early this year, our clients stopped calling us. So the result of that is we stopped invoicing and your AR dropped. We created a new floor that we have been operating on this entire year. And this floor has been very painful for a lot of us. Joel, you're saying that some people, were running months without any new accounts receivable being generated. Some they gained, and we called that out already in previous weekly briefings, where that there seemed to be some specialists that were needed in this time, and they didn't feel the pain as most industry. But this AR drop is there. Here's what's encouraging, and I think we can all feel it. Again, if you're looking at the second line from the bottom as a baseline, you'll see right now, towards the end of this last quarter, we've actually creeped up to the other side of that. So that's really good news for us. That's showing that I think today, I have a lot of clients calling me today and saying, wow, we're super busy. It feels like November 1st, the faucets opened up again. But this little gain right here is this gain that we're looking at. We're excited about that. Here's the bad news. It's always busy at the end of the year. If you looked at the end of last year, 2022, there was also an increase. And 2 years ago, there's also an increase. So to have an increase every single year at the end of the year is natural. We're feeling that it's not correcting itself. It's not going up to where it was when we started or it finished last year, but we're feeling that natural curve, which most likely means that we'll have a natural curve back down in January. So this is the moment we have to preserve our cash flow. These are not growth moments. There's just a season that we can capture, gain a little bit, and preserve into Q1 like we always do. No new strategy there.
Are you seeing the little arrows I'm drawing on my screen, Tim?
Yeah, that's great.
Okay, cool. I get a gold star.
Yeah, you did.
Okay, anything else you want to say here before we keep on trucking?
Nope, this is great.
It's kind of cool. And like seeing that, oh yeah, that fourth quarter. One of these days we'll see it go down and we'll be like, whoa, something totally different just happened. Okay, what are we seeing assets here?
So this is total assets. So this is where basically all your accounts receivable and your cash on hand and other assets are combined. So we have a gain in accounts receivable. We still have a decline in cash. Those are the last two graphs. We put them together. We have a flat line. I think a lot of us are thankful there's a flat line. I think that we felt really horrible in Q1 and that decline was a lot. And we've really kept a flat line or survival line for the last 2 quarters. And I think if you ask me, that feels good. This is how we get through the time. There will be an uptick. We just have to buy ourselves the time when we do it. Cash flow. This is what we need to be doing in this moment. So this is where projecting the next 12 weeks, looking at what's coming in, matching our expenses to revenue, really preserving our cash, our checking account balance. So that's the one we have to focus on here. And how do we do that? Cash flow. So this AR will allow us to maintain our business, but we have to always match our expenses to the accounts receivable.
So I wrote this question here because does total assets, if I'm running my studio, does total assets include AR?
Yes, that's right. So the reason why it flatlines is again, the first grid was basically bank accounts that was going down, AR was going up, and the two combined give us a flat line.
Okay, next.
Yeah.
AP.
Okay, so here's what's interesting about accounts payable. Many of us see accounts payable as just like a negative. It's a thing that draws from our checking account, which is true. Like that's what it's doing, it's drawing. But this is also where other people stay busy because of us. Accounts payable is often the result of us hiring freelancers. So if AP is dropping, it means we're not using outside resources as much. If it's increasing, it means that we're getting busy and we need them more often. So when the cliff happened with our jobs and our accounts receivable, we also stopped hiring people. Early year decline. That actually happened. Remember this? Happened actually November, December last year is when we stopped hiring freelancers, and we heard it first there. Freelancers' rates got adjusted earlier this year, but we've been kind of working with that trend. We got a slight uptick, got like into a busy cycle, Q2, Q3, and now Q3. And Joel, look at that last bit there, where it's just slightly increased at the very, very end there. That means people are busy because we're asking for freelancer help right now. That's why our AP is going up. Now, that's good news. It's showing busyness. Our AR should be matching that a little bit better. But I think some people are reporting for us on cash basis, or they're not always tracking the same and putting all of their invoices into QuickBooks. So we have to recognize our data has a little bit of an offset there. But this busyness is good news to me.
Footy at Trick and Mortar was asking, is this cash basis or accrual basis, which is a really good question. Maybe give everyone the answer why that's a nuance that's worth noting.
Yeah, we run reports on accrual basis and we bring it in on an accrual basis, but we're not in charge of everyone's bookkeeping, which means that in some cases, accrual is when you match your revenue to your expenses. So if you're 30% through a project, no matter how much cash you received from that project, you would say, I received 30% of the revenue. On a cash basis, you would receive the revenue based on whatever the check amount is that you deposit. So that slight difference gives us a slight offset here because we might be missing some accounts receivable brought into here. But as a global trend over a 3-year cycle, that's why I look at so long. That nuances and the amount of agencies we have in this report, it's a little nuanced. But I'm saying the busyness here, that's the key factor. We can see people getting back to work with a slight uptick right now in AP.
Isn't it interesting, Tim? Again, that fourth quarter thing, if I'm just going to call it from, whoops, we got a straight line arrow thingy here. So notice that, right? And then notice, let's see if I can get my to year end right there. And then here we are, right? So I'm asking a question mark here. Like, will this year be like last year? There does seem to be some likelihood. So it's just interesting.
Yeah. What it doesn't say is that we're super busy and that will carry us on to Q1. But we're seeing, and I think we're feeling it too, the busyness. So this is where you're feeling and you're seeing couldn't reconcile.
By the way, good job, Kendra, switching to accrual basis. We love that because, yeah, if your cash basis up to around $1 million, maybe 2, but then when you get to accrual, you're like, oh my God, we get so much flexibility. So we like to hear that. All right, credit cards. This is always an interesting one because you and I were talking with our teammate Jakin behind the scenes and saying, what do you see here? And what he said, I was like, dang it, I see the same thing.
Yeah, this unfortunately means that people spent the same money twice. So if we would go back to the checking account balance, Joel, and you can see that slow decrease. This is you spending your cash out of your accounts, your savings account, your checking account, and that's in decline. At the same time, you also depend on your credit card. So you spent the same dollar twice and you uptick your credit card. So that just means it's going to be harder to get out of this hole. Consumer debt is so bad because it takes 4 times as much effort to get ourselves out of that than it is to save from it. It's not that I don't understand why or how you get stuck in that, because it often creeps up on us. We do the usual spend or a usual cycle, especially if we're putting credit card expenses on our credit card for clients, and then the payments are slow to come in. They start to build up, and that could be kind of a bad relationship with you and your client. But specifically the inability to pay off that credit card, it's nice, it's easy credit, you can float it, but we really have to address this. We need to get this credit down. So maybe if you're having a really good quarter now, your cash dump might be better suited on paying off that credit card than to bring on something or pay for some other end of your expenses. My recommendation would be to be slow on that credit card payoff, just a little bit slow, meaning like, let's wait till we're into Q1 as we start going at it aggressively. And I would look at towards other expenses, cutting them back sooner than later so we can make up for this debt. Because this is not one we want to be stuck in.
It's interesting to see the credit card total as of early September has not been that high for well over 2 years.
Yeah.
But it is encouraging, right? Because we do see this little, we're starting to go down. So that is slightly encouraging, right?
Yeah, the visibility here is important, and I'd have to go up to double check. But I can understand where credit card balances go up while bank account balances are going up, because it means we're busy and we're just using our cards to get points or whatever. See how the trend is going up on cash and credit card? That means we're just spending the same dollars and exchanging them from card to account. It's when it's going down and credit cards are going up, that's the big uh-oh. We don't want to see cash going down and spending on credit cards. That's where you're spending the same dollars twice.
All right, total liabilities. Interesting.
Yeah, so what's happened to us, this is combining all the liabilities here. What's happened to us is the liabilities dropped off the shelf when the projects start coming in. So that initial drop that we see early 2023 is the dropping of projects. We dropped accounts payable, that major cliff creates a drop in liabilities. But since the second quarter, it's slowly creeping up on us. My thought here is that we probably should have made more drastic changes earlier on in the year, and we were slow to do it. We should have cut back staff earlier. We should have right-sized our business and our services differently. We should have asked for more money on projects instead of charging the same and producing the same results. So with those types of things that we've been slow to move on, we get this slow creep. Let's just recognize today's the moment. We have to right size this stuff. So don't give the client more than they paid for, period. Right? They're the one that sets the budget, not you. Give them the right work for that right amount. Work on who you're bringing on board, what your expenses are as they're getting those projects done. And then specifically, let's be very careful with how we're spending our money. Let's keep ourselves in check, but let's not take it all away from the owner. That could really harm the business too. So that whole pay yourself first mentality has got to still be part of what's going on here.
Yeah, Kendra's got a couple good questions, and I'm going to preface it by saying, Tim, when I look at this year, how many times did I hear an owner say, yeah, Tim, that all sounds great, right? Charge the same, don't over deliver. But there was a new variable that got thrown in this year called, every project got delayed or postponed. And so now those liabilities, right? The liabilities keep coming every 2 weeks, payroll, et cetera. But the money you're getting gets stretched out. And I'm wondering if that's part of what we're seeing here, is that stretch out of revenue.
Yeah, I think that's where those lies hurt us even more, because when we're really, really need the work, and then we have this hope that something's going to come, we compromise so much more because the reality does feel that close. And it takes very strong discipline to match expenses to revenue at all times. Working with clients, I don't always, just cut because our revenues dropped. We're looking for opportunities to look what's going on with revenue and can we correct it on the revenue side as well as on the expense side. But now we're looking at 6 months of slow liability increase. The reality is, hey, this is the wake up call. We need to start right sizing our business.
Yeah, I'm wondering if you have a quick thought. Kendra's asking this, any tips for how to watch out based on accrual, right? For something to watch out for. How did you get killed, if you don't mind me asking? That said, we have a credit line we've been using to fill in cash flow gaps, which I like, right? If it's only to manage a client that pays you slowly, love that.
Yeah, it's just once you hit that, you just have to be disciplined. Once you take that out of your line of credit, you need to know the date you're going to pay it back for sure. That line of credit payback should feel as important as making your health insurance payments and payroll payments, because that's the promise you made that when the AR comes in, you're going to match that line of credit payment to it. If you don't keep that accurate on your cash flow, you're slowly buying extra time of that line of credit, and that can do a lot of hurt to you and your business.
Well, that's the latest, right, news from the wilds of the industry. I think it's going to be interesting just to see how this fourth quarter plays out. And I'm also going to just put a little plug, because Tim, there's some sort of a standard or a guideline or something that we as an industry, I've been harping on this for a little while, of how do we handle postponements, delays, obviously cancellation and kill fees. We're not going to solve it in the next 2 minutes that we have here, but I think we all need a common language called, you need to delay the project, no problem, here's what we're going to do. And it's like we all treat it as a standard, rather than, well, none of the other studios we work with are charging us when we put the project on hold. We need to really change that narrative and figure that out.
Yeah, I kicked up a new engagement this week, and right into that situation, Joel, is where I was headed with them. And the easy thing to explain of why we often don't see that need to increase the project revenue because of a delay is because we're thinking commodity based. You're like, well, I assigned person for 3 days. They've only worked 2. That 2-week delay for that gap, but then finally I use that 3rd day of that person's rate. That feels like what was in the budget. And the reality is like, no, the assignment of those days work within a timeline, and you schedule and you build based on that. So that delay does cost you money, and the client should be compensating you for it. It's just part of the engagement, but it is like this hidden cost if we're only thinking on a commodity basis. So
And I will say, guess what?
Be careful of that.
Everyone here is totally accustomed to a situation called, oh, you want to fly whenever and change your ticket whenever and fly back whenever. That ticket costs 3 times as much. So there's a way to productize that offering called, oh, if you want that flexibility, here's that offer. If you want to get the lowest price, here's that offer. But it's not, we're so scared, right? We're so used to just the status quo that we think, oh my God, if I tell my clients that, they'll hate me and won't ever give me a project again.
We feel like lucky they picked us, right?
Flex
so
prices.
2024, we got to start looking right now. You should start looking at your pipe drive. Start looking at your possible projects coming in, HubSpot, wherever you're pulling that revenue. Start putting together a bingo card of projects and sizes of those projects that you're expecting in the first 2 months of 2024, and start putting names to those projects and find out if those clients are going to call you. You start doing outreach, finding out those projects that usually are there, are they going to come in, and get a sense of what your early Q1 is going to look like. It's really important right now as we're maybe on a win cycle for the next 6 weeks. We want to know how long this is going to last and what our responsibility is while we're winning.
So as a final thought, what was the percentage? Remember when we asked last week, how many of you expect Q4, right, to be an increasing quarter versus a down quarter? And I want to say it was something like 2/3 of people said they expect things are going in a good direction. Is that about right?
Yeah, that's, my memory serves me well too. Yeah, let's say that, Joe. Yeah.
Don't quote us on that. Okay.
Watch the video. It was more than we expected. So I'm going to say 2/3 seems about right. Yeah.
Yeah. Well, I appreciate everyone for jumping into this week's briefing. It's always fun for us, right, to be able to do this for all you guys and gals, because it's this moment where we get to aggregate all this information. So if you're interested in participating in this and adding your data to it so you can get a lot more detail behind the scenes, reach out to us. Just go to RevThink.com and you'll see a way to get in touch with us. And if you're not a member of the community, we certainly welcome you to jump into the community of our.
We should say there was a question, and I think we often hide this, but we do have a level of engagement. It's our lowest level of engagement, but we have a level of engagement that we collect the data. We do quarterly reports with folks, and we give them some of our tools, the roll up and cash flow. So it was asked, where do we get this and how many agencies? But it's beyond our one-on-one clients. We also have these long string quarterly engagements we have with folks. So that is available for people. I don't think we talk about it enough, but that is where this data comes from. And if that would be helpful to you and be part of this and get these one-on-one meetings with us once a quarter, we'd be happy to get that started with people as well.
Yep. All right. Thanks again, everyone. Tim, thanks for letting us put you in the hot seat and
fun.
play the part of prophet.
There's a lot going on. I feel like this year's been tough in a lot of ways. So I'm glad that we get this visibility into it and can share it. I think it's so helpful and healthy to kind of know where you stand and look at your personal trends. Don't lie to yourself. Look yourself in the mirror and know that you can do it and do it well. Anything we could do to help, as always, reach out to us in community, send us a DM. We'll happy to jump on a call, whatever we need to work you through it.
All right. Thanks, everyone. Have a great rest of your week, and we'll see you next week for another briefing. If not before then, in the community or out there in the real world. See you, Tim.
Bye, Joel.